Welcome back to Ask the Lender. Interest rates sometimes seem scary. Craig, can you enlighten us on the current positive trend of interest rates?
The Fed rate is different than mortgage rates, to be crystal clear. There's some tendencies that it can kind of have an effect, but it's not a direct correlation of what's going on. What is a correlation is a 10-year U.S. Treasury bond. And there's different bond timelines. And so what a 10-year bond means, it will mature in its 10th year. So if you buy that bond and you wait 10 years, it matures at 10 years. And the reason why there's better correlation between a 10-year bond and a 30-year fixed, most mortgages today, probably I'd say over the last 15 years, usually change, meaning refinance or the house is sold so the mortgage is paid off, usually lasts between 7 and 10 years. That's a very typical window for loans today and where they've been, like I said, the last probably 10 to 15 years. So the 10-year Treasury bond has really some great correlation to that because of that window. So with that being said, I know the graph definitely overwhelming. There's no doubt, but we're going to try to simplify it. And I will point to the fact in our current times, and right now we're just about ready to start the fourth quarter, October 2025. We are trying to maintain this 4.20, which is 4.2% on the 10-year bond. That is a magical number. When we've been above that 4.20, interest rates are higher. We get below that 4.20, interest rates get lower. For a long time, over the last nearly 3+ years, we've had our bond, that 10-year bond has been 4.5 or more. So it's been much, much higher. So now we're trying to settle in here at 4.20. So that's something that anybody at any given time, if you just Google 10-year US bond, you can pull it up and see it in your phone. Think of that 4.20 as hopefully will be the new ceiling. And then if we touch that ceiling, then we come back down. So today, the 30th of September, we are sitting here at 4.15 versus 4.20. So that's a good thing. We're below that 4.20. So that's something you want to keep in mind for sure. I will share then the other part of the conversation is that we definitely are in a world still where rates have, and I think will continue to be, as I would call it, a little higher, but we're going to be lower than what we've been because we've been averaging 6.75 on our 30-year fixed. We're in the neighborhood of 6.25 right now. So we've gotten 0.5% better in rates, which is a very, very good thing. The other part that we continue to watch all the time is inflation and the inflammatory cost of what it is to go out and buy eggs, that the eggs cost more than what they did. A part of the Federal Reserve, kind of circling back to the Fed, they've got a double mandate. They watch inflation and they also watch jobs. Those are the two things that they are absolutely trying to impact in a positive way. So they want lower inflation. Their number is 2.0. We're just above that. We're probably 2.8, 2.9. We'll see how that goes. But the jobs number here of late has definitely had an impact in a negative way where we're not creating as many jobs as we have been. So moving that Fed rate down allows businesses to go out and take more money out at a lower rate, grow business. And if I grow my business, we hope we need more workers because there's more work to be done. So that's kind of where that, sits in this puzzle of different pieces that kind of go into that. And then I think, long term, as I project what even 2026 looks like based on, some of the information I've shared today and just a couple other tea leaves, if you will, is the sheer fact that we see interest rates really around that 6% number for the next 12 months. Could we get to 5.75? Sure. We could have a couple, windows where we touch that for sure. Could we stay around 6.25? Sure. We could do that. But instead of being at 6.75 or even 7%, we can definitely see ourselves in that 6% range and then still using all those affordability factors that you and I have talked about, as far as instead of maybe dropping price, we hold price, but we take that difference that we were going to ask in dropping the price and use that to lower the interest rate, which will also impact monthly payment. Monthly payment is everything, speaks to that affordability factor. Again, having the right team members on your team, being able to take all this financial data and make sense of it in a simple way. That's what you and I for sure hope to do all the time. And then being able to execute a game plan using that data so that we can absolutely take advantage of getting the most out of the money that people are willing to spend on a monthly payment. And when we do that, we've created a win-win situation. And that's the goal.
Thanks, Craig, for joining me on this series and sharing about interest rates. Looking forward to sharing more to help future homebuyers start their home buying journey with confidence. If you're looking to start your real estate journey, reach out and let's make your dream home a reality.